Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your host, AlgoBot, and in today's session we're exploring an expert advisor called Biweight Band Reversion. This strategy takes a robust statistics approach to mean reversion, building its fair value line from something called the Tukey Biweight estimator. Over the next few minutes you'll learn how that estimator works, how the strategy defines its fade bands, how it decides when a market is calm enough to trade, and exactly how the entry and exit logic comes together. Let's get started. So what does Biweight Band Reversion actually do? At its heart, this is a mean reversion strategy, which means it looks for moments when price has stretched unusually far from a central fair value, and it positions for a snapback toward that center. What makes this expert advisor different is how it defines that center. Instead of using a simple moving average, a median, a volume-weighted price, or a trimmed mean, all of which can be pulled around by a single sharp spike, it uses the Tukey Biweight estimator of location. This is a robust statistic that repeatedly re-weights every bar according to how far it sits from the center and completely discards any bar beyond a scaled cutoff distance. The result is a fair value line that reflects where the ordinary, well-behaved bars agree the market belongs, rather than being dragged off course by outliers. Around that center, the strategy draws a pair of fade bands, spaced by a multiple of a robust measure of volatility. It also draws a wider pair of guard fences further out. Price stretching past the inner band is treated as an overextension worth fading, but price pushing all the way past the outer guard is treated as a genuine breakout and deliberately left alone. Crucially, this approach only looks to fade when the market is calm and ranging. It measures the slope of its own center line and only considers trading when that slope is nearly flat, avoiding established trends where mean reversion tends to struggle. Its natural home is a liquid foreign exchange major or a metal on time frames from 5 minutes up to 1 hour. It's designed for traders who are curious about statistical, range-based methods and disciplined risk control. Remember, this is educational information only, and every trading approach carries the risk of loss. Let's walk through the mechanics step by step. On every newly closed bar, the strategy looks back over a rolling window, 40 bars by default, and takes each bar's typical price, the average of its high, low, and close. From that window, it first computes the median, then the median absolute deviation, a robust measure of spread. Multiplying that deviation by roughly 1.48 gives a figure that behaves like a standard deviation, which the strategy calls sigma. Next comes the Biweight itself. Starting from the median, the strategy repeatedly recalculates a weighted center. Each bar receives a weight based on its distance from the current center, divided by a cutoff distance set by the tuning constant. Bars close to the center get full weight, bars further out get progressively less, and any bar beyond the cutoff gets a weight of exactly 0. It drops out of the calculation entirely. After a handful of iterations, the center settles on the value the normal bars agree on. From that center, the strategy builds a lower band and an upper band, each set a multiple of sigma away, plus a wider lower and upper guard fence. It then checks the regime. It measures how far the center has moved over the slope loopback period, expressed in sigma units, and only proceeds if that slope is below the maximum slope setting. This is the flat, ranging filter. Now the entries. For a long, the strategy signals when the just closed bar closes below the lower band but stays above the lower guard, and that bar is bullish, the first hint of a snapback. It buys at the ask, sets its take profit exactly at the center, the robust magnet, and places its stop a multiple of the average true range below entry. A short is the mirror image. The bar closes above the upper band but below the upper guard, and is bearish. It sells at the bid, targets the center, and sets its stop above entry. Before any trade, a minimum reward to risk filter rejects setups where price already sits too close to the center. Only one position per magic number is allowed, and a spread filter blocks entries when spreads are too wide. Finally, a break-even lock moves the stop to the entry price once the trade travels a set fraction of the average true range in its favor, so a trade that half works and then reverses costs nothing. Let's look at the actual MetaTrader code. At the top are the inputs. Windows sets the rolling lookback for the center and its dispersion, defaulting to 40 bars. Tune C is the Biweight tuning constant that fixes the cutoff distance. A lower value rejects outliers more aggressively. Band multiple sets the fade band width in robust sigma, and guard multiple sets the outer breakout fence. Slope loopback and max slope together define the flat regime filter. ATR period, ATR stop multiple, and break-even ATR control the stop and the break-even lock, while min reward risk enforces the minimum reward to risk ratio. Now the long block. The condition reads, if the signal bar's close is below the lower band and above the lower guard, and the bar is bullish. When that's true, entry is taken at the ask, the take profit variable is set to the center, the robust fair value magnet, and the stop is placed one stop distance below entry. After confirming reward and risk are positive and the reward to risk ratio clears the minimum, the code calls trade.buy with those stop and target levels. The short block mirrors it exactly. If the close is above the upper band, below the upper guard, and the bar is bearish, entry is taken at the bid, the take profit is again the center, and the stop is placed one stop distance above entry. The same reward to risk check runs, and then trade.sell is called. Notice both sides always target the same center line, and both always attach a protective stop. This is educational information, not financial advice. Let's bring this to life on the chart. Across the screen you can see a candlestick sequence with 3 lines drawn over it. The gold line running through the middle is the robust fair value, the Biweight center. The red line above it is the upper fade band, and the green line below is the lower fade band. Further out, the 2 gray dashed lines are the guard fences, the outer boundary beyond which a move is treated as a real breakout rather than an overextension. Notice how flat the center line stays across the whole sequence. That flatness is exactly the calm, ranging regime this strategy waits for. Watch the opening candles. Price is hovering near the center, drifting gently. Then, on the second and third candles, sellers take control and price slides down, pushing through the lower fade band. That third candle down is a bearish bar that stretches well below the green band, yet it stays above the lower guard fence. So this is an overextension the strategy is willing to fade, not a runaway breakout it would stand aside from. The very next candle is the one the strategy has been waiting for. It opens near the lows but closes higher, finishing as a bullish bar that is still below the lower band. That is the first snapback signal. Because the regime is flat, the spread is acceptable, and the reward to the center clears the minimum reward to risk ratio, the strategy signals along. You can see the buy entry marker on that candle. The stop loss sits down near the guard, a set multiple of the average true range below entry, and the take profit is placed right at the gold center line. From there, price does exactly what the strategy anticipated. The following candles climb steadily back toward fair value, and when price reaches the center line, the take profit target is met. That completes the long trade, a fade of an overextension back to the robust magnet. Notice how the center acted as the destination, not a lagging average trailing behind. Now watch the second half of the chart. Having returned to the center, price keeps pushing higher. Buyers drive it up through the upper fade band on a strong bullish candle. Again, price stretches past the inner band but stops short of the upper guard fence, so it qualifies as a fade candidate rather than a breakout. The next candle rolls over. It opens higher but closes lower, printing a bearish bar that remains above the upper band. That is the mirror image snapback signal for a short. With the regime still flat and the reward to risk check satisfied, the strategy signals a sell. The sell entry marker appears on that candle. The stop loss sits above near the upper guard, and the take profit is again set at the center line. Price then eases back down over the following candles, and when it reaches the gold center, the short take profit is met. Both trades share the same logic. Wait for a calm market, wait for price to stretch past a band but not past the guard, wait for the first bar that snaps back, and then aim for the robust fair value in the middle. And remember the break-even lock working quietly in the background. Once either trade travels a set fraction of the average true range in its favor, the stop slides up to entry, so a trade that stalls and reverses would cost nothing. This is a clear, disciplined illustration of robust mean reversion, shown for educational purposes only. To wrap up, today we explored the Biweight Band Reversion Expert Advisor for MetaTrader 5. We saw how it builds a spike-resistant fair value using the Tukey Biweight estimator, how it draws its fade bands and guard fences, how it only trades when the market is calm and ranging, and how it manages every position with an average short-range stop, a minimum reward-to-risk filter, and a break-even lock. If you found this breakdown helpful, please like the video, leave a comment with any strategy you'd like us to analyze next, and subscribe so you don't miss future episodes. You can find more educational strategy analyses over at www.algobot.live. Everything here is educational information only and not financial advice. Past performance does not guarantee future results. Trade responsibly.